But where the big game is to be played is China. China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now.
Hey everyone, and welcome back to Crypto Alpha. Today we're listening to an insightful update from Raoul Pal, CEO of Real Vision and expert economist. But before we get started, please don't forget to like the video and watch it until the end to get the full insight into what you might want to consider for your crypto holdings. Renowned macroeconomic expert Raoul Pal addresses the current concerns surrounding the crypto market and the broader economic outlook. He offers a calming, bullish perspective, arguing that the current market downturn is a temporary phase driven by past tightening. Pal emphasizes the cyclical nature of markets, urging investors to remain patient and avoid panic selling amid short-term volatility. Now then, let's jump straight into the laptop to watch the update.
This is the Don't Fuck This Up rule book, and it's how to navigate these times. No leverage, right? Anybody with leverage being blown up. No FOMO, so don't chase the peaks and don't sell at the lows. The further you are out the risk curve, the further your bag is down now. That's okay. I have SUI, Solana as my main holding, so they're down more. Bitcoin is down less. You need to understand the risk curve. Then don't get fleeced. Don't lose control of your tokens by attaching some stupid website. Only have a small DJing bag. Remember when everybody thought that memes were going to be the biggest thing of all time? They've all gone to zero. That's because that's so far out the risk curve. It should be small and it should be there for fun, yet unlikely to make a fortune. The longer term time horizon is everything. Zoom out, remove the noise, and most importantly, expect 35% pullbacks frequently in Bitcoin. And that means more in alts. And buy the fucking dip if you can. So those are the rules, so don't fuck this up. Understand that as we go through the presentation, and you'll understand the opportunity set. So let's go through the everything code. The everything code is the overall thesis of my understanding of how we got to where we are today, where we're going, and how it all comes together. I've said before, everything is demographics. The labor force participation rate is a representation of the demographics in the US economy. The US is better than others. Europe has worse demographics, Japan worse, China worse. But this is what drives economies, inflation, and it also drives government debt. As the population ages out, this chart is one that I'm surprised that nobody's copied from us and is probably the single most important chart in all of macro. Government debt is a function of aging populations. It is there to paste over the cracks. If you remember, GDP growth equals population growth plus productivity growth plus debt growth. Debt growth is the part that is papering over GDP growth. It is filling in the cracks. It is very important that you all understand this. But as debt to GDP increases, it becomes harder and harder to figure out how to finance it. So what comes along is the use of liquidity. Now, we've used Fed net liquidity here. We'll talk about total liquidity later. The governments have shifted, the central banks and governments have shifted from originally balance sheet use back in 2008 when everything blew up till about Draghi and just after that period. Then they started using net liquidity. That's when you use the Treasury General Account. That's when you use the reverse repo. So you're bringing in the private sector into this and the government balance sheet, not just the central bank balance sheet. And in recent times, they've moved beyond that to use total liquidity, which includes the banking sector. But basically, all liquidity is there is to service the government debt. This chart is incredibly important for you to understand. So zooming in where we are today, you can see that US total liquidity, so that includes the banking sector now, which is the new mechanism by which they're absorbing the debts and mandating banks to hold more government bonds. You can see it follows this debt to GDP chart. And here's the chart that drove the everything code. This is the interest payments going forwards, and here is liquidity rising to meet it. This is how you service the massive debts. You pay the interest. You do it via currency debasement. That's what liquidity is. It's a fancy word for currency debasement. And total liquidity is the way that they've been doing it. Now, this is not new. This was all done after World War II, when at the same time the world was massively in debt. We had lost a large part of the working population via war. And we then had to erode the debt via financial repression. Financial repression is when you keep yields lower than growth or lower than inflation, but generally lower than growth, nominal growth. And what happens is that over time, GDP rises, but debt doesn't rise as fast as GDP, and you erode away the debt. And that's via debasement. So that was very common in the 1950s. That lasted about 2 decades. We're about, where are we now? 2008. We're almost 2 decades into this episode. And interestingly enough, the S&P now very much follows the S&P in the 1950s. And what we had then was the everything code as well. We had this perfect 4-year cyclicality that plays out very similar to the cyclicality now. That cyclicality is the debt refinancing cycle. So in this stupidly colorful chart that nobody can read, and if you're colorblind, you're totally fucked. But imagine you could see it. You can see all of these colors, and basically each color is a year. And in liquidity terms, these are broken into seasons. So we're currently coming into the fall season, or autumn if you're not an American, because fall sounds stupid because what leaves fall or something, I don't know. But anyway, the autumnal season, and it's the nice autumnal color on the chart if you're not colorblind, is when you tend to see the main debts roll. So we've got about 9 or 10 trillion of debts to roll this year, and you need a large increase in liquidity. The last cycle, 2020, most of the liquidity actually came earlier because of COVID. But generally speaking, the liquidity cycle is this year. So we're expecting an expansion of liquidity. Now, there's various proxies for liquidity. Global liquidity is the important one, but it lags global M2, which is a faster reported series. Global M2 is driven a lot by the dollar, plus all of the private sectors and the government sectors around the world. So we found that these two have been really what matters. So when we think, now these are global numbers, everyone gets confused. The Fed are going to cut rates. It's irrelevant. It's irrelevant. It's this global liquidity that pays the global debts. Don't forget, 50% of the entire world's debts are in US dollars. That's one of the things that Scott Bessent has been talking about. Steve Merrin's ideas are about, is trying to reduce that. Good luck to that, but that's what it is, and it's the global cycle. So we know that the dollar is weakening. We'll talk about that later. That's a big part of this. We know that interest rates are coming lower, which is part of global liquidity and also part of financial conditions. We know that the US has been using a drawdown in the reverse repo and the Treasury general account. It will rebuild because of tax season coming now, but generally the US is injecting liquidity. It will not use the balance sheet yet, but it may well do later in the cycle. We need to see. But where the big game is to be played is China. China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now. They're in a full debt deflation. And China's going to be very important to this story. And it's the most important headline that is going to come is what the agreement is with China. So the agreement with China will be, and I've been talking about this for a year in Global Macro Investor and Real Vision Pro Macro, the agreement with China will be, you will agree to tariff terms. We will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem. The Chinese have a dollar debt problem and they need to service those debts. The problem is the RMB is too weak and the dollar is too strong. They don't have the cash flows in a slow economic environment to pay for it. They know, the US knows. Yellen even went to talk to them about it when she was still at the Treasury. They need a weaker dollar. Now, the mechanism by which China gets access to those dollars is usually via the euro-dollar market, and it's Japan that is the big driver of the euro-dollar market. So when we look at the weakening of the dollar, I like to focus on dollar yen to think of how this plays out. The yen is one of the world's big exporting economies, and it has a very weak currency. The yen needs to strengthen, and a strengthening yen and a weakening dollar will allow capital to flow into China and other dollar borrowers via the euro-dollar market. And the key thing that happens here is this chart of the Chinese currency against the yen. The Chinese currency was too strong versus the yen, and that has been putting pressure on Chinese exporters and the Chinese economy. It needs to rebalance lower, and this head and shoulders top and this head and shoulders top tell us the US, Scott Bessent, is going to get what he wants, which is a weaker dollar. A weaker dollar will stimulate global demand. It stimulates and allows for the rolling of global US dollar debts. It allows for exports and imports to free up. It allows for the movement of trade, even with tariffs. It's a very big deal, the dollar weakening. And if China can have a weakening yuan, a strengthening yuan, a weakening yuan against the yen, what it allows them to do is to compete. And that rebalances global trade and gets the global growth cycle going. So China headline risk to the positive side is the big one. Everything else is kind of noise because this is the big rebalancing that the world kind of wants. Everyone has a trade-off here and everybody will come to the table for a trade-off, even China. But of course, everybody needs to look like a tough guy in negotiations, but something will happen and we will rebalance and we can move forward. This is exactly what happened last time when Trump was in power in 2017. What we had was called the Shanghai Accord. It was a kind of public, not public agreement to weaken the dollar to allow the Chinese to stimulate because they need a weaker dollar to stimulate because they don't want to weaken their currency via the currency band because if not, you get a devaluation, which they do not want. So that was the Shanghai Accord then. The dollar fell dramatically and the Chinese stimulated massively. If you remember 2017, the Fed were raising rates. They were shrinking the balance sheet, but China and Europe stimulated. And that was via this mechanism. So this time around, we've got the Mar-a-Lago Accord, which is some generalized understanding that an agreement has happened. Now, I know this is all going to be complicated. Those of you who are Real Vision Pro members and GMI members, you'll get my transcript from ChatGPT where I go through this in detail and stress test our ideas against it. It's a phenomenal tool if you haven't used it.
The banana zone remains intact. Despite the recent pullback, Bitcoin is still significantly up from its lows. Historical patterns, particularly the 2017 cycle's volatile but ultimately upward trajectory, suggest that corrective phases are normal within a larger bull market. The gap between Bitcoin's price and global M2 remains significant, indicating substantial upside potential if the historical relationship holds. It's a wall of upside to come. That's the message from Raoul Pal, the CEO of macro investment firm Real Vision. So what do you think? Is there reason to panic, and is it still just a case of waiting for the bull run to begin? Please leave a comment with your views below. We read every single one and will usually reply to you as well. So that's it from Crypto Alpha for today. Thanks for watching, and we'll see you next time.